How's it going, guys? I hope you've all had an excellent week. I'm getting this video to you a little late as I had family in town this past week and I never had the chance to research and put together a video. But now we're going to be talking about the first market rally of 2023, and holy smokes, what a rally it was. If we look at the markets today, the Dow closed up over 700 points, S&P 500 up 87 points, and the Nasdaq closed out 264 points in the green. Now, what led to this intense market rally that we saw today? Well, we got two pieces of data that just came out. We got jobs numbers from December, and those jobs numbers show that despite the economy adding 223,000 jobs, we did see a decline in wages, and wages only increased by 0.3%. as opposed to the 0.4% that analysts were projecting. Now, what does this mean for the economy? Well, if people aren't going to be earning more money, they're therefore going to be spending less. Spending less contracts the economy and gets you back to that projected 2% inflation rate, which is what the Fed is aiming to achieve, hopefully by the end of this year or going into 2024. Now, the other piece of bad news that came out today. Now, we must understand that in this current economic situation that we're in, bad news is good news for the stock market, because investors want to see that this out of control spending starts getting controlled and starts coming down. Unfortunately, when people start getting laid off, it is good news for stocks, because the companies now are laying people off and they're going to get their expenses in check. They're going to be spending less money on wages, and so that is going to help the stock price in the long run, at least. So the other piece of news that came out was from the Institute of Supply Management, or the ISM, and they came out with service data. And what the service sector data showed was that business expansion fell to 49.6% versus a projected 55%. So what that means is that businesses actually reduced their size in the month of December, and they also showed that new orders fell 10.8% and business activity and production dropped by 10 points. So bad news in the service sector, meaning that services that people are requesting are getting less, which means that people and businesses more than anything are requesting less of those services. Therefore, the economy is going to be shrinking. Therefore, inflation is going to be coming down, and then we're going to get back to that projected 2% interest rate. This, in any normal economy, would be bad news, but now things are reversed, and bad news is good news for these assets that we're buying into. And when I saw that first initial good news come out with the wage decreasing, I went ahead and added one share of Amazon to my portfolio. Amazon is a company that is literally cut in half over this past year, and they are a company that I believe in, and I will continue. If you saw my last video, I will continue to believe in them, and I'm adding along with other companies going into this new year. Amazon is well positioned to ride out the storm, and they've actually just laid off 18,000 people, which is very unfortunate for those people. But if we're looking at the stock, this is what investors want to see, because like I said, they are now laying off less money on wages so that they can go ahead and cut their costs and focus on other areas of the business. So guys, that has been the quick update video for today. We saw this huge market rally of 2023. We got the CPI numbers coming out for December on January 12th. So I'll break those to you, and that's going to show us just how inflation was carried out in the month of December, which will lead the Fed to their next rate hike decision. So thank you guys for the support. I appreciate you. Remember to check me out on Twitter and Instagram, and keep your head in the game. Look after each other. I'm wishing you all an excellent 23, a profitable 2023, and I'll catch you guys on the next video. Take care. Cheers.